Hello there. In this video, we will be continuing with our series, Learn Fundamentals of Accounting 1 First. And in this video, we will be talking about income statement. Income statement. So in this video, I will first of all start with the format of the statement, and then we will do a practical question to show you how a question on income statement is done. So let's get into it. So this is the format of the income statement, and you can maybe pause the video and just write it, but also we can just write it as we proceed, because I will explain how the format is. So I don't know if you can see it as a whole. Yeah, that's good. So that is generally the format of the income statement. So if you look at it, I said it in the first video in this playlist that income statement is basically your revenue, okay? Revenue subtracting the expenses. So the moment you find your total revenue and then you subtract by your expenses, now this is the value of total revenue. The moment you subtract by the expenses, you will get net profit, okay? So basically that's it. So how we calculate our total revenue? First of all, we start by calculating the main revenue of a business, of which each and every business has a product it is selling. Okay, so here we will just assume a business which operates in a manner that they do purchase goods and they sell them to make income for the business. Okay, so in this business, the main activity that they do is they buy goods and they sell them. So when they buy and sell, they get gross profit. Okay, and if that business has any other revenues, it adds those revenues onto the gross profit to get the total revenue. And then once the business has its total revenue, now it starts subtracting its expenses which it has incurred for that period. And when they subtract that amount from the total revenue, they will get either a profit or a loss. So this value can be either a positive or a negative. If it is a positive, net profit. If it is a negative, net loss. Okay? Yeah, so now how do we get the main source of income of a business, which we call gross profit? How do we get it? We get it by taking the net sales and then you subtract by the cost of goods sold, or rather cost of sales. Okay, you've noticed that there are some digits which are having the bracket sign. This shows that this value is to be subtracted less. Okay, so first of all, we start with the sales and then we less return inwards. So the moment we take sales and we less return inwards, just as it has been illustrated here, you will get this figure which is called net sales. So if you look at it keenly, this value subtracted by this, we all know that in normal operations of mathematics, the answer normally comes here. So in accounting, it is different, whereby the result of the operation which you've done, the answer just goes alongside it. Okay, it goes alongside the last item on the right. Okay, now if you look at it, it has 4 columns. It has the details, then currency columns, which are 3. So normally the currency items are 2 normally, and they just help us in making our work look neat. Yeah, basically that's it. So if you look at this is the last column. The last column is for doing the final calculations. Okay, for instance, in order for me to get gross profit, because that is the last calculation, it is the net sales when you less cost of goods sold. Okay, but the net sales, I haven't gotten the amount of net sales just by looking at a question. I needed to calculate it. So this column is for either making the final calculation or stating your answer. And then these other 2 columns is for doing calculations. And you will see as we progress. So this column, I have used it to calculate the net sales. Okay, so that is step 1, calculate net sales. And then with this net sales, the other step is to less this amount with cost of goods sold. Some of you call it COGS, some of you call it cost of sales, some of you call it COS, whichever suits you. So we less from here cost of goods sold. But the amount of cost of goods sold is not being given directly. So what do? We need to calculate. So we calculate not on this column, but on these 2. Okay. So for the opening, so what consists of cost of goods sold? We have the opening stock, which will be given in the question. So since this one is given, we write it in the middle column. Okay, this is where the main calculation is normally done. Okay, in some income statements, or rather how you were taught in class, I'm sure there was there wasn't this column. Okay, for me, I usually place this column when I am to calculate the net purchases. Okay, but this is normally the main column for calculating, and this is the column for writing your answer. This column is optional. So opening stock is given, you write that amount, and then in the question you may be given purchases and you will be given return outwards. So return inwards is also known as sales returns, while return outwards is also known as purchase returns. Okay, so in opening stock, what you are to add onto the opening stock is what we call net purchases. So this value is net purchases. And how do you get net purchases? Because maybe if you will be given, you will just write it there and there will be no essence of you calculating. But if you are not given the net purchases straight from the question and you need to calculate, then this is where now this column comes to use. Okay, because you will need to calculate for the net purchases and then you place it there. Okay, So how do you calculate net purchases? It is purchases and then you less return outwards. So purchases less return outwards, you will get, correct, net purchases. Okay, so now we already have two. We have opening stock, we have net purchases, and then also we have what we call carriage inwards. This one is also part of the cost of goods sold, or rather cost of sales. So carriage inwards, you add that figure and then you less the closing stock. Okay, so when you do opening stock plus net purchases plus carriage inwards and then you less closing stock, this amount which you will get, you won't write it down here, you will write it beside, just alongside it, onto the right to this column. So this figure which is inside is now the cost of goods sold or cost of sales. But since we are to less the cost of goods sold, now that is why this figure is in bracket. Okay, so net sales less cost of goods sold is what will give us this figure, which is the gross profit. Okay, so if there are any questions, please reach out in the comment section and I will answer. So after you've gotten your gross profit, now you add revenues, other revenues. Okay, so other revenues can be discount received. Discount received is recorded as a revenue. Also rent income. Okay, also commission received. Okay, those items which bring revenue to the business, or rather how the question will just unfold, anything that the company is receiving is recorded here under revenues. So what I felt was a sense to talk about was the discount received, because some confuse it with the discount allowed. Okay, so you can list down here as many revenues as the business has. Okay, it doesn't need to be two. And also, if the business doesn't have any revenue, you will just exclude this part from the format. Okay, this format is very flexible. In a question, you can find out that maybe you are not being given return inwards. So what will you do? You will just write sales, and this figure you write it here. Okay, because there won't be of essence for you to calculate for the net sales, yet you are not given the return inwards. Okay, same goes to the cost of goods sold. You may not be given return outwards and carriage inwards. So what will you do? You'll just write the opening stock figure, you write the purchase figure, and then you less the closing stock. Okay, for you to get the cost of goods sold. Okay, so this format is just, it has included everything that a question can ask, but it doesn't mean that if you are not given return outwards, you still place it in the income statement. Okay, so this format is very flexible. If you are not given any item which is here, don't include it. Okay, yeah. So now when I now come and talk about this revenue which is of essence, it's normally called provision for bad debts. So in a calculation, you may find out that under the provision for bad debts, there is either over provision or under provision for bad debts. The moment there is over provision for bad debts, it is considered as an additional amount to the revenue. Okay, an additional amount to the revenue. So let me even delete this. Okay, when it is over provision, it is an additional amount to the revenue. If it is under provision, you will subtract it from the other revenue. If there is no other revenue, you will subtract it to the gross profit. Okay, so please take note, if there is over provision, it is counted as an addition to the revenue. If it is under provision, you less it from the business revenue. Okay, yeah, I hope this one is clear. So the moment now in this example, I have discount received and over provision for bad debts. When I add those figures, I will get this amount, and then now this amount, when I add it to the gross profit, I will get the total revenue. Okay, now from the total revenue, I come and now less operating expenses. Okay, you may have very maybe those expenses which are recorded in the information which you're given, you'll just list them down, each and every one of them, and then you add them. Okay, then once you've added them and you've gotten the figure, the summation of all the expenses, you place it alongside, and since you are to less the operating expenses, that figure will be in bracket. So it will be total revenue minus the operating expenses for you to get net profit. Okay, so I've used various examples of the expenses. There is discount allowed. Discount allowed is an expense. Carriage outwards is also an expense. Okay, do you remember carriage inwards? Now carriage outwards is an expense. You remember discount received? Now discount allowed is an expense. Then bad debts is an expense. Loan interest is also an expense. And then depreciation for that period, it is also an expense. Okay, yeah, so you will see the practical bit of it when we do a question. Okay, now when you have more revenue than expenses, this value will be positive and it will be recorded as net profit. But when total revenue is less than the expenses, this value will be a negative value, meaning that it will be a net loss. Okay, so this is the format. Okay, I hope that we've gone step by step with you all. Okay, so if you didn't record this, please pause the video and just write this format down for remembrance. Okay, so let us do now a question. So when we are doing a question on income statement, you will be given what we call a trial balance. So we already talked about a trial balance in our previous videos. If you haven't, you can please go and check on Academic Booster channel. So we said that the moment now in the first video, once you've already created your trial balance and it has balanced, now you can create an income statement. Okay, so now we have a trial balance which has balanced, and we are required to prepare an income statement for the year. Okay, now this is a practical question. So I would suggest that you pause the video and just write this trial balance. Okay, yeah, pause the video and just write this trial balance so that we can move step by step in this question that we are doing. Okay, once you are done, you can also include this additional information, which will help us to find some figures. Okay, so now let us start. You have the trial balance, and once you've seen that the trial balance has balanced, now you come to the additional information. Okay, when you are told to prepare an income statement and you have additional information, what you start by doing is to understand what you are being told here in the additional information. So in Roman 1, we are being told stock as at the close of business was valued at 25,900. So if you look at this period, this is the trial balance as at 31st October, meaning this is the end of the year, end of the accounting year. Okay, so if it ends 31st October, it means that the other year will start at 1st November. Okay, that one is very key to understand. So stock at the close of the business, so meaning that one is closing stock. So the closing stock is 25,900. Okay, did you see a place in the income statement where we have a place where we will include the closing stock value? Okay, so we go to Roman number 2. Depreciation for the year ended 31st October 2024 has yet to be provided as follows. So now we are calculating depreciation for the non-current assets that we have. We have property and we have equipment. You are being told 1% depreciation using the straight line method. So the moment you are using a straight line method, so for the straight line method, I think now it is clear. So for the straight line method, what you normally do is it will be the depreciation percentage you multiply by the cost of the non-current asset. This is the formula of calculating depreciation using the straight line method. Okay, so for property we are being told it is 1%. Okay, we are being told it is 1%. So it will be 1 over 100 multiplied by the cost of the non-current asset. We come to our trial balance. Trial balance property at cost is 90,000. So 90,000. We get 900. Okay, so 900 is the depreciation for property for this period. Okay, what about equipment? For the equipment, it is 15%, so it will be 15 over 100 multiplied by the equipment at cost is 57,500. So 57,500. So when we do 575 multiplied by 15, 8625. Okay, now we are done with Roman number 2, calculation of depreciation. Okay, now we go to Roman number 3. Roman number 3, we are being told wages and salaries are accrued by 140. Wages and salaries accrued by by 140. Okay, so what do we mean by accrued? This means that in relation to the wages salaries, okay, let me just say for the wages and salaries it is 52,360. Okay, 52,360. So what we mean by accrued is that this figure of wages and salaries, the moment we say accrued, we say that it is due to be paid. In that period, wages and salaries haven't been provided fully to the workers. Okay, so wages and salaries accrued just means that the value which is being given for the wages and salaries is not the correct figure. It is figure which is less. Okay, so now there is a concept that I would like to just say it before we continue. In an income statement, you provide figures as it should be. Okay, if in that period you have 20 workers and each worker is being paid 100 or rather 1,000, then for wages and salaries in each and every period, you will need to pay them 20,000. The business will incur an expense of 20,000. Okay, this is what is expected, and the income statement records the expected value of expense. Okay, so when you provide a value which is less, let's say for instance you are to provide for 20,000 as the wages, but you provide 15,000. Okay, this normally happens. Okay, maybe the business has promised to pay the workers the remaining 5,000 maybe the next month or rather the following accounting period. Okay, this one, it is through words, but under the income statement you should write 20,000. Okay, even if you pay them in advance, you pay them let's say 30,000, you won't record this 30,000 in the income statement. You will record what is required, which is 20,000. Okay, so according to this question, now we return to the question. 52,360 it is what was paid as wages and salaries. Okay, but this value is accrued by 140, meaning that what is required for the business to pay as wages and salaries, that figure has been reduced by 140. So how do we get the required amount? Since this has been reduced by 140, we add on to it so that we get the required wages and salaries, which we should include in the income statement. So 52,360 plus 140, we'll get 52,500. Okay, so this is what is to be paid by the business as wages and salaries. Okay, and this is what needs to be recorded in the income statement. Okay, even though this is the reality of things, the income statement records the required values. Okay, any question, please just reach out in the comment section and I will reply. So this is the adjusted amount in wages and salaries expense. Okay, so this we will use it in the income statement. We won't use this figure, this one. Okay, now that is the importance of the additional information it normally gives us info which we need to update the values in the trial balance. Okay, so now under wages and salaries, which is one of the expenses, we will use this figure. And this 140, we will use it in the statement of financial position as a current liability. Why is it a liability? The business paid the workers 52,360, but the required amount is 52,500. Okay, meaning they have to pay the workers in form of wages and salaries 140. Okay, they haven't finished paying the workers, so this 140 will record it as current liability because they are obligated to finish paying the workers. Okay, so if it is understood, then we can say that any expense which is accrued, that figure which the expense has been accrued by, we add it onto the given value, and then that figure we will record it in the statement of financial position as current liability. Okay, I hope it is understood. So let us go to Roman number 4. So in Roman number 4, other operating expenses include certain expenses prepaid by 500. Other expenses included under this heading are accrued. So we have here other operating expenses. So here they've just categorized some expenses which maybe not to make the trial balance long. Okay, so maybe there could be rent here, there could be electricity expense, lighting expense, transport expense. So they've just added them all together to get 38,800. Okay, so we are being told that expenses which are in here, there are some which have been prepaid and there are others which have been accrued. Okay, so the opposite of accrued is prepaid. Prepaid expenses are expenses which have been paid even before you haven't utilized them. Okay, so this is like paying in advance, and this is like paying less amount. Okay, when you pay in advance, you pay what you are required to pay, and you pay also something more than what you are to pay. So this is like paying more than required, and this is paying less than required. Okay, so the moment you pay more than required, that figure which is more will be recorded as current asset, and under accrued, just like in this example, that figure which has been paid less by, in this case it was 140, you include it as current liability. Okay, so for instance, the expenses which are being prepaid, they are prepaid by 500. Okay, so here it is being prepaid by 500, and other expenses are accrued by 200. So since this 500 has been paid in advance, and it is, so if you interpret it correctly, some expenses have been paid as required, but also they have been paid with an amount which is more. And in this example which I talked about earlier, I said that in an income statement you record values which are required to be paid for, we are only dealing with required amounts. Okay, so if you pay in advance or you pay less, we will record the required amount in the income statement. So here we are looking for the required amount that the business needs to pay in the title other operating expenses. So the expenses which are been paid in advance, now this 500 will go to the statement of financial position as current asset, and this 200 which is accrued will be recorded in the statement of financial position as current liability. Okay, so now this amount will need to be adjusted, so it is 38,800. Okay, so now this value which has been recorded has 500 more. So in order for us to get the required, we will need to remove this 500 so that we get the required value. And this value which has been paid less by 200, we add that 200 onto this figure so that we get the required amount. Okay, so 38,800 plus 200, and then you subtract 500, you will get 38,500. So 38,500 is now what we will use when we record the income statement under other operating expenses. We won't use 38,800. We will use 38,500. Okay, so we are remaining with Roman 5 and 6. So Roman 5, the provision for bad debts is to be adjusted so that it is 0.5% of trade debtors as at 31st October 2020. So allow me to open the other page, Roman 5. So provision for bad debt provision for bad debt in the trial balance has been given as 280. Okay, as per trial balance it is 280, but now under the policy provision for bad debt, the policy as at 31st October 2020 is that the provision for bad debt is to be 0.5 of trade debtors. Okay, and we need to adjust that value. So as per policy it is 0.5% of trade debtors. So we come and see where are the trade debtors. So we have trade debtors and creditors, and we have two values, so meaning one is for debtor and one is for creditor. So which one is for debtor? Yeah, the debit one. Okay, this is the debit, this is the credit. So the debit value is what stands for the trade debtors. So 46,200 is our trade debtors. 46,200. Am I correct? Yeah, 46,200. So let us do the math. 0.5 over 100 times 46,200. So 0.5 over 100 we multiply by 46,200. We will get 231. Okay, so this is what is required for us to provide for bad debts. But if you look at what is provided as per the trial balance, it is 280. So now, what is the essence of providing for bad debts? Now, we all know that the moment someone borrows some money from you and you lend them, there is a certain probability that that person won't be able to pay you, maybe because due to lack of a proper example, maybe the individual died. So someone who has died cannot pay debt back to you, okay? So you will consider that as bad debt. So for businesses, they normally provide for that bad debt, okay? So here, when we are talking about 0.5 over 100 of trade debtors, the business, as per the policy, is that in case these debtors, some of them fail to pay, okay? Some of them fail to pay. In case they fail to pay what they are required to pay us, fortunately, we will be having some money. So the moment we are saying provision for bad debt, this is a safety net. Safety net when someone now fails to pay for the debt which he or she is owing to the business. Okay, so this is just like a safety net whereby a business just provides for a scenario whereby a debt can be considered as bad debt. Okay, so now the value of trade debtors will need to reduce. Okay, trade debtors are 46,200. Okay, since we are providing for bad debt for 231, we subtract that 231 from the trade debtors in order for us to know now who is that individual whom we have recorded as trade debtor, who we will now ask for our money. Okay, we cannot now ask for debtors 46,200 and we have already provided for 231. Okay, so we subtract this value and we will get 45,969. Okay, so if you look at it as per the policy, okay, originally we have trade debtors as 46,200. As per the policy, we have provided 0.5% of the trade debtors, 231. Okay, so this 46,200, 0.5% of it we as the business have provided. Okay, now the remaining 99.5%, this one now will remain as now our debtors. Okay, I hope it is understood. So now the value of trade debtors will be 99.5%. Okay, and it is this value. And then now 231 is what the business is providing for, the 231. Okay, so since the business is providing for bad debts, the value of trade debtors will reduce. So this value of trade debtors, we won't use it. We will use this value. Okay, and this value we will only use it in the statement of financial position. Okay, but now this 231, it is what we will use as provision for bad debt. Okay, so now since that one is understood, as per the trial balance, what was provided was 280. But now through the calculation as per the policy, we are to provide 231. So the trial balance provided 280, and now as per the policy is 231, meaning that originally this is what was being done initially, and this is what was being done in the as per the policy. Okay, if you look at it, okay, if you look at it, so as I was saying, initially it was provided 280, but now as we have calculated, it is 231. So if you look at it, it was over provided. Okay, the provision for bad debt was over provided. We were to provide 231, not 280. So since we over provided the amount, we over provided by how much? It is the difference. 280, we subtract 231, we get 49. So it is over provided by 49. So this 49, we will return it back to the business. Okay, we over provided this amount. We just needed to provide 231, but we have provided 280. So the 49, which is in excess, we will return it back to the business as revenue. Okay, so over provision for bad debt is recouped back to the business as revenue. Okay, so this 49 will be recorded as revenue. Okay, yeah, so we are done with Roman number 5. Now we go to the last one, Roman number 6. Purchases include goods valued at 1,040, which were withdrawn by the owner for personal use. Okay, so in Roman number 6, we are just being told that if we look at the value of purchases, the value of purchases is 259,600. 259,600. Okay, we are being told that this value includes 1,040, which is drawings. Okay, we are being told that purchases include goods valued at 1,040, which were withdrawn by the owner for personal use. Things which are drawn for personal use are drawings. Okay, so this is like an investigation which was done, and they found out that these purchases includes some goods which were taken as drawings. Okay, so what do? We just adjust this figure by subtracting. Okay, so the moment we subtract 259,600 by 1040, we get 258,560. Okay, now this is the adjusted purchases. Okay, so since this one was included in purchases, then it means it wasn't included in the drawings. So we also need to adjust the value of drawings. So drawings is 28,930. So 28,930, we include those values which were not recorded. So since 1040 is part of drawings, we add it. And when we add 28,930 plus 1040, we will get 29,930. 970. So 29,970 is the adjusted drawings. So when we are recording our purchases and our drawings value, we won't use these ones which are in the trial balance. We will use the adjusted figures. Okay, yeah, so we are done with the additional information. Those items which we were to adjust, we have adjusted them. Okay, so now we are able to prepare our income statement. So we first of all start with the name of the business. The name of the business is Enterprise A. So Enterprise A. Some of you may have been told that the title, you should write it in capital letters. So please do as you have been told. This one is just for illustration purposes. So income statement for the year ended 31st October 2024. 31st October 2024. So we will use 2 columns. We write the currency and then we start. So in our format, we normally start with sales. Okay, so we look at our trial balance. When we look at our trial balance, we see sales here. But when you are looking at sales, you also look at return inwards. Are there return inwards? No. So we only have sales. So sales is 405,000. So since we don't have return inwards, we are not writing that value here. We are writing it here. So 405,000. That is our sales. Okay. So since we have sales, what are we required to do? We are required now to go to less cost of goods sold. And in cost of goods sold, we start by writing the opening stock. So where is the opening stock? Here it is. Stock as at 1st November 2023. Okay. This period ended 31st October. When it starts at 1st November. So this period was 1st November 2023 to 31st October 2024. So this is the stock. This is the opening stock. Okay. So opening stock is 27,400. 27,400. So that is why I told you at the beginning of this video that it is essential to know the date of the books of accounts so that you don't confuse yourself. So after opening stock, we go to purchases. I remember we adjusted our value for purchases. Okay, so we are not using this value. We are using the adjusted value. But what we are looking for in our trial balance is if there is return outwards. No, there is no return outwards. So we write this figure as adjusted purchases. So we add. It is 258,560. Okay. Do we have carriage inwards? No, we don't. So we ignore it. So we less closing stock. we were given closing stock at the beginning, 25,900. So as I was saying, the value of closing stock we were given, and it is 25,900. And since we are lessing, it is in bracket. So we solve it. So 27,400 plus 258,560. That value we subtract with 25,900. We will get 260,060. And since this is our cost of goods sold and we are lessing, we put that figure in bracket. So sales, when you subtract with cost of goods sold, so 405,000, we subtract, we will get 144,940. Now this is our gross profit. Okay, so from here we add other revenue, and I'm saying add other revenues because I saw discounts. And I saw they were two, so I know there is a discounts allowed and discounts received. So discounts received, I know it is a revenue, and revenue are normally on the credit side. So this is the discount received. Discount allowed is an expense, and expenses are normally debit. So this is the value of discount allowed. So discount received is 4,420. So discount received is 4,420. Okay. The other revenue that I'm thinking of is the over provision for bad debts. Okay. If you remember, at Roman 5, we said that the 49 will be recouped in the business in form of revenue. So over provision for bad debts. Remember, I'm not writing provision over provision. The only thing that we are writing here, it's either if it is over or under. In this scenario, we saw that it was over provided. If it was under provided, that figure we could subtract it from these revenues that we have. Okay, but since it is over provision, we add it. Okay, so I haven't seen any other revenue in our trial balance, so I add these two, 4420 plus 49. I will get 4,469. Now when I add on to the gross profit, which is 144,940, I will get 149,409. 149,409. Now this is the total revenue of the business. Okay, now moving forward, we less operating expenses. I have seen very many expenses here under the discounts. Now this is discount allowed. we have wages and salaries, bad debts, loan interest, carriage outwards, other operating expenses. Yeah, those are our expenses. So we have discount allowed. What else do we have? Wages and salaries. What else? Bad debts. We also have, the loan interest. We have the carriage out. We also have the other operating expenses. Oh yeah, also here, Roman 2, we have depreciation. Depreciation is also part of the expenses. Depreciation, okay? You have depreciation for property and for equipment. So let us start listing. So for the discount allowed is 3,370. 3,370. Wages and salaries, we adjusted that figure, I remember, in Roman number 3. So we are writing 52,500. 52,500. Okay. Bad debts, we have it 1,720. 1,720. Okay. And then loan interest 1,560. 1,560. And then our carriage out 5,310. 5,310. Okay. Then our other operating expenses, I remember we adjusted that figure in Roman number 4. It is 38,500. 38,500. So for depreciation, we have Roman number 2. Okay. Property and equipment. So here they are. For property is 900. For equipment is 8,625. Okay. Yeah. So 900 and 8,625. Okay. So those are all our expenses. So we add them. So 3370 plus 52,500 plus 1,720 plus 1,560 plus 5310 plus 38,500 900 8625. I'm getting 112,485. Okay. So since this is the addition of all the expenses, we are to less, so we put that value in bracket and we subtract that value. So 149,409 subtracting, we get 36,924. And this is a positive value, so it is net profit. Okay. So our net profit is 36,924. And since we are not continuing, we are closing. Okay. So I know it has been a long video, but now we can say that we know how to solve a question under income statement. So if this video has been of help to you, please share it with your peers, and for more content like this, please like and subscribe. See you in the next video.